This is an interesting call only because it's not an interesting call. It's for the record now, but it kind of seems like financial markets have priced around this kind of a feel for next year and its rate path. Why is this Goldman note important, or is it not? Is it just setting the benchmark for everybody else out there?
Morning, Tom. I think it's important that the market is basically confirming what the Fed wants to achieve. It wants to get to this point where it could actually lower rates. And if you listen to people like Williams or Goolsbee, they're in that camp. They believe that the rate roundabout is high enough, and if you keep it there for some time, inflation will cool off more, and then they can start cutting rates. Otherwise, they say that the real interest rate gets too high. I think that's important because we are at a point here where nominal treasury yields, as you said earlier, are over 4%. They may indeed start to affect the economy at some point negatively. So these rate cuts are in that sense positive if you believe that the Fed can achieve its goal of lower inflation, meaning positive for the economy rate cuts. So I think it's setting the benchmark. It's an important goal, but we will meet it, we'll see, because as you also say, you have wheat prices and energy prices, that's all on the move. So I don't think we're exactly there yet to call the final rate hike by the Fed.
Ben, the conventional wisdom used to be, perhaps even still is, you don't fight the Fed, and obviously because they've got a lot of ammunition when it comes to power over monetary policy in this country. But is there a point now where the markets are getting it right in terms of where they think future growth prospects are, where future inflation is? If you look at the yield curve right now, in the short end with the 2-year and the 10-year right now at the close to the steepest inversion that we've seen in decades, are we in a good spot for investors to take advantage of some opportunity with regard to at least the Treasury rate side of things?
To an extent, we are. I mean, we're reaching the upper end of that range on the 10-year. That's sort of between 3.25 and say 4.25. And really, that 4.25 level, or maybe slightly above, is about that this Fed gets to its final tightening rate hike, and therefore, there's a real good entry point, particularly because that core inflation is slowing down. But be wary, though, that we do deal with a fiscal deficit and more supply. So I think that keeps the pressure on rates to some extent. But that you're getting to an entry point is clear. I think the economy continues to moderate, and that means slower inflation. That means good returns for bonds.
What exactly, Ben, is your expectation for what that inflation picture looks like? The feeling right now is that we've maybe come close to this process of peaking, and we could see some slower moves ahead. Do you feel as though there could be a flare-up, and could it catch the market off guard?
That risk is always there, Dom. The issue is that, as you explain the wheat situation in Ukraine is one example, or just the recent surge in gas prices in Europe, or just seeing the oil prices moving a bit higher, it will challenge headline inflation again. And that could feed through core at some point. So that there remains somewhat of a challenge. But I think by and large, having done this massive rate hike cycle, it is putting pressure on inflation more, let's say, medium term. And I think this is what the market is probably right about. We're just going to have a little patience next number of months to see how it exactly settles out. But that inflation may not come back the way it did in 2022, because particularly core inflation is probably right.